Well, I think, first of all, I'd very much like to welcome all the panelists and thank you for joining today. We have all their details are in the program, so I'll just introduce them by name. We have Ismael Moreno, we have Alberto Corinti, Hans de Cuyper, and Frank Grund. So welcome. So I think I would like to start the questions, and of course it'll be an interactive process, and we'll also have some time at the end for some questions. But I'd like to ask the supervisors maybe to share some experiences in your market over the implementation and application of Solvency II. So stepping back a bit in time, was the market ready on time? Was significant and enough effort put in? And did the industry and your own organizations cope well with the new requirements?
Yeah, I started at BaFin 1st of October 2015. That means I was only 3 months in the old world, and I realized how active the organization was in preparing for Solvency II. But I think, in general terms speaking, we can be very content with the outcome. I think it was good that Solvency II didn't come into force when it was foreseen. So that was a consistent postponement. I think that was quite useful for the industry and for supervisors. I think it was especially helpful for internal models, which is in our market a substantial market share, that we used the time there for preparing it. But I think in principle, I think we can be very happy with the good implementation.
Yeah, also our final assessment up to now is positive. The transition in Italy has been quite smooth, at least in the immediate term, because we didn't have tension in terms of capital, and companies were already in the feeling of risk management. I have to say, however, that there is still a lot of work to do, both on the company side and on the supervisory side. Because on the company side, we have been mainly focused on the approval of internal models, US undertaking specific parameters, all the authorization aspects. And this led us to know very well the companies that we were authorizing. But we maybe disregarded a bit the companies using a standard formula. And so for this reason, we made recently a thematic review of the best estimate calculation of standard formula users. And we saw that there are still issues to clear, and to improve, because some optionalities were not being taken into account. Assumptions sometimes were too optimistic. So there is a work to do, and what is important is that the governance of the companies is appropriate, because it's important that within the companies there is a check and balances, there is a board who is aware, the key function that works, in order to to avoid this type of miscalculations. On the other side, also for supervisors, is difficult, and it's not. I have to confess, sometimes it's not easy for supervisor to work in a Solvency II fashion, and moving from Solvency I to Solvency II means also, as you know, changing the mindset, and it could be disruptive if the supervisor approach Solvency II in a Solvency I mindset. You spoke about the buffer, and this could be a result of a too rule-based approach of a supervisor. And the other problem we had is how to calibrate proportionality and the intensity of supervision. Now we are trying to do something on that, at least in the pillar 2 aspects. But this is very very challenging. So positive assessment, but a lot of improvement in supervision. And then we can speak about the regulation also.
Yeah. So the journey isn't over yet. From the industry side, your experiences of implementation and the running of Solvency II now for the first 2 years, 2.5 years.
Quite a revolution, as you were saying before. In fact, for companies, it has been probably the most transformational engagement within the last 10 years, and we're probably facing a similar kind of challenge with IFRS 17 now. But up to now, it's been the focus of transformation for companies, at least in our local market in Spain. Investment has been huge. Changes in terms of organizations have been huge. New functions have appeared out of nowhere. The risk function, which has been traditionally a banking sort of role, is now fully embedded within insurers and within the day-to-day workings of an insurance company. And obviously issues remain because as with everything surrounding culture and the day-to-day embedding of something into an organization, it simply takes time. But I think the amount and the rate of change has been dramatic.
Well, I think I can agree with the colleagues here. We have seen a significant change in how I think insurance companies are led. I was there the very early days. It was still called, I think, Groep Consultatif, 2000, 2003, which was more a cry for a new solvency regime. Then I went 9 years to Asia, was far away from Solvency II implementation. Came back in 2013 and I saw the struggle on the numbers, and the modeling was, I think, ongoing strongly. But what had already changed by then significantly was everything what had to do with the governance, the risk taxonomy, thinking about models for the risks, the role of the board of directors and the risk management committee, which gradually have been implemented. And of course the crisis in 2008, I think, have stimulated that even further. So which I believe today is still the main benefit of the whole Solvency II transition. Looking backwards now, I would say we are, I think, very happy with the Pillar 2 aspects, and also everything that has to do with the internal modeling and adjusting the risk measurement to your local company profile. I think also Pillar 3, the disclosures, I think all that is really helping on managing, leading an insurance company. I think the struggle, and you see it also very well in the revision that you are proposing in your presentation, is now how to deal with this standardization conversion that you're looking for in Pillar 1, and what I would call the more correct risk measurements that you're having more and more in Pillar 2. And there is some tension there is some struggle, also when we talk to the investors, to explain how the behavior can sometimes be different, and we are really looking forward that the review that is coming up can actually deal with these issues. Where are you looking for conversion? Where should you stay principle based? Where can internal models even also help you in your Pillar 1 measurement and disclosure? I think that's absolutely key.
And maybe Ismael, if have you maybe we've talked a bit about the positive impacts, and I think, as I said, those are, I think, are very well recognized. Maybe can you give any sense of, in your market, whether there's been changes to products, maybe changes for the better, but also maybe areas where products have been changed or prices which were not necessarily necessary from your point of view, and maybe one of the unintended consequences?
Yeah, it's a very good question, actually. I think there's probably two sides to it. One would be the Spanish local market. Because locally we are, many in the local market are users of the matching adjustment, I think that just because of that, we've had the framework where long-term guaranteed products have been able to survive. When we look at Europe-wide trends, it's probably not such the case. And probably because of the fact that frameworks like the MA are not applied on a European-wide basis, we've seen a sort of shift towards non-guaranteed long-term products, like unit-linked products, for instance, which in our mind poses many, many questions. You know, are we as an industry, as insurers, posed to compete on the asset management front without guarantees, just in terms of superior management of assets, fund management? And that's the type of questions that we ask ourselves when we look at the overall global, European-wide trends. But locally in Spain, it's quite different because we've been matching assets and liabilities using cash flow matching and duration matching since 1999. The market has grown very much accustomed to it, and that has been the key enabler for us to stick to long-term guaranteed products and to maintain an offering of guaranteed products.
And there's still a strong demand from customers for those products?
Oh, certainly, and increasing. There's many trends, social trends, demographic trends, that pose for an increasing need for retirement-oriented products, either before or after retirement.
And not only customers, I think also, I mean, government, social security systems. I think there is a cry for further development of the private market, pension market. I think there is an absolute need to sustain our social security system, and that is becoming under pressure. We have seen it first in the long-term business, specifically in Belgium, reducing significantly investments in equities, which I think form a normal part of long-term pension business. I think that has significantly reduced. Now we have seen last few years, because of Solvency II, not only Solvency II, also because of low interest rate environment, also because of tax, but we have seen several players closing shop. So really stopping the guaranteed pension business in Belgium, fully or partially, which I don't think is good for the role that we are playing in the economy. And then I'm talking about on the social side, but also on the economic side, because pension insurers always have also been the biggest investors in the local economy, be it with government debt, corporate debt, or even corporate shares. And I think that is becoming under pressure while the need is still there. So we really hope that the review can deal with the long-term business issues. Yeah.
And Alberto, in your market, are you seeing these trends? And maybe also you can highlight any changes that were sort of necessary and positive, but maybe also whether you're also seeing these trends which were maybe not actually intended.
You mean in the market?
Yeah, in the market, yeah.
Yeah, we also have this trend towards unit-linked, not guaranteed products, and which is something that I agree with the other speakers, that is not fundamentally good for insurers, and maybe not also for consumers. And you can say that this was also, you know, if you want, pushed a bit by Solvency II, but clearly Solvency II is part of the environment, and so Solvency II, I think, has not been the main driver for those type of changes. It works also in combination with other elements, like, for example, the low interest rate scenario, but also other impacts that we see. For example, consolidation in the market. Consolidation could be somehow a result of Solvency II, but there are also other reasons for consolidation, like the need to invest, to find synergies, to invest more, to cope with the need for investing in IT developments and so on. The same with investments. We didn't see a lot of changes in the asset allocation in Italy, except now that we are testifying a decrease in investment in Italian sovereign bonds, but I don't think this is due to Solvency II.
It's not the worst.
But unfortunately, by other reasons connected with the political situation. So Solvency II has influenced, but maybe together with other elements. The issue on which maybe we should take care of is actually this issue of the guarantees. You know, we should check, and we also as a supervisor, we are keen to check whether the regulatory approach and the supervisory approach do not penalize guaranteed products. This would be a bad trend. And so, and I guess we will come back on this issue. We think the long-term guarantees aspects of Solvency II need attention.
Okay. Frank, in your market?
Yeah, I think we did not see a huge shift in asset allocation, as you said. We didn't see that in our market. Perhaps we see now a little bit more in alternative investments, but that is more due to the low interest rate. But we didn't see a dramatic shift from equity to bonds, for example, in our market. I agree absolutely that we have to think about the feasibility of long-term liabilities in the regulatory framework. I think EIOPA just is working on that, and I could encourage you mentioned academics, and I did that in another opportunity. We should really ask for more intellectual input into that exercise. I think we are not creative there enough yet. EIOPA is starting that working group, and I think we should really invest there some intellectual energy, and I would ask for contributions from the industry and from academics as well. I think that's very important. It's worthwhile, because I absolutely agree the USP of insurance business is to give guarantees, and obviously whether it's financially rational or not, you could doubt about that. Obviously, customers, at least in our market, prefer to have a financial guarantee. On the other hand, we have to see that there are some political discussions in our market that the German government wanted to encourage employers and unions to invest in non-guarantee business. We do not see there so much appetite yet for this non-guaranteed business. Insofar, I think, being in a very traditional market, customers still like guarantees, and I think insurance industry should work on that USP.
Well, indeed, we tend to see that when the markets go up, there are some markets where there is less interest, but as soon as markets go down, then I think the customers realize the benefits involved. But in terms of but have you seen within your market changes or generally have you seen changes in design of products? Because we've seen some. We understand that there are some changes. For example, a move from annual guarantees to end-of-term guarantees, and change in design, which maybe are sort of have certain benefits from a risk point of view.
Yeah, we see that change, guarantees that they are not on a permanent basis, but more on the end of the payment period, and then I think we see more or less 100% guarantees in the payment. How do you say that, in the pension period? I think that is still normal, but companies are trying to get lighter capital requirements for the payment period. But I think in our recent survey, I would say still 60% is with a certain type of guarantee. Customers seem to look for guarantees. I'm not sure whether the change is was due to Solvency II or simply due to economic reality. If you see that stock-listed companies had these discussions in the early years of this century. In 2000, they started to develop less capital-intensive products. I think it's not only due to Solvency II, but I agree that Solvency II made it for everybody clear that guarantees cost money.
But if I look at the Belgian market, I would not say that so much product change has been done. There is also less a need. I think the focus, and that's a positive thing, has really shifted to the asset liability management on long-term guarantees. So it's the mix between the assets and the liabilities. On the liabilities, there was not so much work to do because in Belgium, in the pension market, first of all, we do not have a real annuity market. In Belgium, we have a market where everybody receives its capital at the age of retirement. We also have a market value adjustment mechanism. It's not fully adjusted to the products yet, but at least there is an MVA for when interest rate goes up. We have a relatively flexible system to reduce guarantees. Profit sharing is discretionary for the insurance company. So we have a lot of product features today that you would say if in the right modeling and calibration you can deal with those risks and you can close those risks. So interest rate risk, capital charge for instance, for those companies who have a healthy asset liability management is not a major issue in Belgium. It is more an issue in areas where the models are not yet functioning. And then, as we said, we're talking about investments in equities in the long term, and we talk about the credit risk versus the spread risk and the whole VA mechanism, which I think will be a topic in a minute. So that is nothing an insurance company today can solve because it is some of, I would say, the flaws in the way how it is designed, and that should be subject to review. So it's not so much work to do on the liability side. It's more a little bit on the modeling.
There's some degree of debate going on in the industry as to what the Solvency II perfect product would be. It would be a product that would be capital efficient, and at the same time it would have to be attractive for the policyholder. And in that sense, it should contain some sort of guarantee, as we were explaining. And I think that's a yet unresolved question, but it's an interesting one. I've heard many suggestions as to that so-called hybrid products, unit-linked products with some sort of guarantee, the old time, what we used to know as variable annuities at the time, with all its connotations, could be the answer to that, and could be what, in a direct or either indirect way, Solvency II would be indirectly promoting as a product solution. But again, that's probably an open question yet to be explored.
Yeah. And it may be the 2020 review needs to come into that discussion as well, but we'll come back to that in a moment. Maybe before continuing with some of those issues, we focused a lot on the long term and the life products. Maybe just briefly touch on the non-life products and the shorter ones. Are there any issues there that are sort of fundamental, or as opposed to maybe some of those detailed technical issues we mentioned earlier on in my presentation? Or is this largely a long-term life issue, as it were?
In Italy, we do not have big issues related to Solvency II. As I said, many companies had difficulty, or didn't think that the standard formula reflected that risk profile. For this reason, they asked for the use of undertaking specific parameter on certain models. But the changes in the non-life products are mainly driven by different aspects. I don't have evidence of Solvency II driven issues.
I can agree. It's less an attention point, except maybe again the longer term business, and then I'm talking about workmen's compensation and some of the healthcare products. There I think are still some attention points, but they are very similar to the life attention points. I also see that some good internal modeling in the non-life market has been going on in recent years. So I think there are less concerns in that area.
I agree with that. Perhaps some smaller items, for example, for specific types of products, which we are working on, legal protection insurance in Germany. That was an issue. The standard formula is not covering well, but In general terms speaking, I think we do not have a big issue with non-life business.
Then maybe going back to those the long-term issue and maybe asking the industry representatives, we've heard already about the MA and that's been helping you maintain the business model. Maybe Hans, you can talk a bit about the VA and some of the challenges you see there in terms of whether it's capturing the real economics of the business and therefore where we need to look for improvements going forward.
Well, the mechanism, the principles of VA or MA, and at the end of the day, if you would adjust it to the company profile, it's getting very close to each other. So it's not so much whether it's now MA or VA, but the principle as such, to really take the credit risk out of the full spread issues, I think is the right way to look at it. The main issue, I think, here is again the way the VA mechanism is calibrated and defined. I think what we have seen is in the crisis of 2008, but even more the one of 2011, we have seen insurers going back to their home market. It was maybe a little bit seen as a safety haven. I remember debates saying, but you know, if it really goes wrong and I have all my government debt in my own government, at least I can talk to them to have some mitigating measures. And it's probably more difficult as a Belgian to talk to the Italian government or the Portuguese government when I need. So that is something that we have seen happening, and the VA is not, I think, respecting sufficiently the asset mix of the company itself. We use a VA, what we call a company-specific VA, in our Pillar 2. It works perfectly well, and we are very fine. So we look at our asset mix, we apply the principles of VA on our asset mix, and then it functions quite well. In the Pillar 1 it doesn't, and I have very opposite experiences. Strangely enough, what we have seen happening in Italy recently, we see our solvency ratio slightly going up. Why? Because our portfolio is not calibrated the same way as the way the base portfolio for VA is. If I would have the same issue in Belgium, and that's when I really need the VA, because that's where the majority of our government debt is, then I would have the opposite effect. It is having some effect, but it's definitely not sufficiently. So for us, the debate is the principle as such is good in its concept, but the way it is calibrated, it should take into account the asset liability management profile of the company, and it should definitely take into account the asset mix of the company.
Yeah, I completely agree. I mean, to us, there's two significant differences between the current VA framework and the MA framework. One is what Hans was just explaining. The VA, first of all, doesn't recognize your own asset portfolio. And to us, that's an inconvenience in the sense that, by definition, it causes volatility in own funds. The second, which we also find interesting, is the fact that the MA is associated to a certain risk management practice, to a certain risk management framework. In other words, we ultimately believe that the MA promotes and actively incentivizes prudent risk management practices in the area of ALM in particular by requiring cash flow matching. Some say that the framework may be too rigid. We've been using it in Spain for almost 20 years now, so it's like your old pair of shoes. You fit comfortable, however hard or rigid they may be. But there's also the possibility of reviewing that if some countries would find it interesting. But to us, ultimately, the difference is significant, and it is the fact that at the end of the day, when we mean that Solvency II should be a risk-based framework and should promote risk management practices, we believe that should not only happen by Pillar 2 or via internal models, for instance, and all the requirements associated to internal models, but also via elements like the MA or the long-term guarantee package as a whole.
And from a supervisory point of view, can you see that, I mean, first of all, there's those discussions going on within EIOPA, do they cover all of these aspects?
Yes.
And
I think so, that we have the chance in the LTG review to bring all these issues on the table. Whether the outcome will be as you expected, I don't know yet. I think it depends very much on the right arguments. I would not see there a VA which is giving a lot of incentives for investing into very risky assets. I think that would not be the right VA. And we know all the problems 26 countries in Europe have with the MA, because it only works in Spain and England. So that cannot be the right answer. I think we should really invest more time in this work stream for long-term liabilities and long-term assets that is linked. And we are quite optimistic. We want to support it, but it should still be a risk-based, prudent system, and not just making some changes in the VA calculation, the 65 going up to 100%, and that is fine then. As I heard it last year in autumn, I think that is not a sound and reasonable discussion. Let's go very deep into it, and we are prepared for doing that.
And just can I maybe, even if that means a net release of capital, because is that accepted, that could be the outcome?
I think if it's reasonable, then that should not be the issue.
Yeah. Okay.
Go ahead.
No, I think when you made your presentation, Olav, I like it that you highlight that one of the main achievements of Solvency II is to at least the attempt to measure the risk, you know, through a stress test approach. But this is maybe the main achievement, but also a main shortcoming of Solvency II, because you assume that you have to sell all the assets in one year. And so I agree that we need an adjustment. We need a correction to this undecided effect of Solvency II. And we think that having a good functioning adjustment, like matching adjustment and volatility adjustment, are the right direction to take. We do not think that the current way in which they are designed and calibrated are appropriate, and I agree with Hans on that. Here you have to strike a balance. You should give this relief to the companies, the possibility not to have the short-term volatility impacting on the solvency ratio, but under, within prudential limits. So you have to allow this relief when the company is really matched and is investing in sufficiently high quality investments. So I think that we have, again, to strike a balance here. We should design a volatility adjustment that really works in, smoothing the volatility without becoming, a permanent relief for the discounting of the liabilities of the companies. Because this is not the objective of volatility adjustment. The volatility adjustment is there in order to smooth the short-term volatility that has nothing to do with the long-term guarantees of the companies. So we think that this is the most important, let's say, area of Solvency II that should be reviewed if we want to maintain a possibility for companies to release long-term guarantees. But volatility adjustment is important for the spread risk, but obviously there is also equity risk that is relevant under this point of view, because you can also not be obliged to sell all your equity in one year. So maybe we have to look to those and the side effect of a stress test approach, which is important, I think, because it allows to take into account all the mitigating mechanisms within the companies, assets, liabilities. It's important. But, you know, at least for spread risk and equity risk, we need some corrections. And the current correction, at least for spread risk, are not, in our view, appropriate.
One comment here would be, you know, we're discussing the VA and the VA and the MA as if it was a question of countries or practices, and to some extent, you know, we tend to look beyond that. We at VidaCaixa have a large MA portfolio, but a significantly large VA portfolio as well. So we live with both. And how we do sort of reconcile that? You know, to us, MA portfolios are those with fixed cash flows, annuities. Fixed annuities is a clear example. That is the sort of product that simply calls for MA type of management as a risk management framework. And then there's the VA framework for largely the rest. For instance, long-term products, but with short-term interest resets, floating interest rates, interest rate guarantees, annual guarantees, for instance. So long-term products with short-term guarantees, so to speak. That is, from our perspective, our VA type of products. And you know, we like to think it that way. We like to think of the two frameworks as complementing and offsetting each other in a way, in the sense of adapting to the circumstances of each type of long-term guarantee.
It's also partially a philosophical question. It's the second time I heard Ismael saying a minute ago, like, what would be the optimal Solvency II product from a capital consumption return point of view, or adjusting my asset mix to the VA. In my view, that's the world upside down. The first principle would be, what does the market need? What does the market need as a whole, and what does the customer need? Then secondly, you design, and then we go back to the basics of Solvency II. That means it's a risk-based framework, principle-based. So that means that you measure, you control your risks, and then for all the outstanding risks, you quantify and you hold the capital. I think that would be the right order of things. We had also a debate internally on this VA mechanism and how do we explain to the investors, where the finance guys, they said, look, it's easy. You reorganize your investment portfolio and you match the VA mechanism. So you sell Belgium and you buy some of Italy and you buy some of Portugal and you buy some of Spain. While the investment guys said, no, wait a minute, we are managing the portfolio on a strategic asset allocation mechanism. And that's how we quantify the exercise and how our optimal risk return mix would be. I'm more in favor of the latter one. And then you say, no, you look at your product, you look at your strategic asset allocation, your asset mix, and then you're going to quantify what the correct outstanding risk positions are of the company, and then you hold the right capital for that. So that's, I think, we should not move in a direction that we say because of conversion, because of standardization, everybody will have to adjust its positioning in the market and to deal with Solvency II. No. Solvency II should still go back to the basics. It's principle-based and a risk-based framework for the company so that it can better internal manage and quantify the risk exposures it has.
Yeah, and that was exactly my point. You know, when you discuss the optimality in product design in a Solvency II framework, you know, the first conclusion that springs to mind is unit-linked products, protection products, and property and casualty. That's what springs to mind as where your strategy should focus. And if you look at the strategy, the publicly stated strategy of many multinationals, European multinationals, that's exactly where they're heading to. Unit-linked products, protection products, and property and casualty. And that's what I was sort of challenging before. You know, if you take customer needs into account and combine it with optimality of capital in a Solvency II framework, then you may arrive into a different conclusion. But obviously taking customer needs into account. If you forget about that, then you you may be sort of forced into that conclusion. Unit-linked, protection, and property and casualty.
But unit-linked is the good example, because first unit-linked, what you actually say is employer, and I'm talking about the corporate pension schemes, you say employer, on the investment risks you're on your own.
Yeah.
It's your risk. On top of that, in Belgium, we have a legislation that the employer must guarantee today 1.75% to his employees, right? So he's even more in a squeeze between, or a risk between unit-linked and that guarantee. That's one. Secondly, if you say unit-linked, then my first reaction in corporate pension scheme would be, but why they're not a pension fund? I mean, pension fund, no capital, no issue, you're on your own. And so why should I hold unit-linked for, at the end of the day, for the market, for the employer and the employee to offer more or less the same product?
But I think that's one reason why certainly our general message has always been we're in no way looking to move away from the risk-based approach. We're trying to make sure that we're measuring the right risks. And if that means certain things can't happen, that happened before, that's life, and those things will have to stop. But what the regulation shouldn't be doing is preventing normal things that can happen. It's just, and are only prevented because the regulation is causing the barrier. And I think that's really where I think it sounds that where I think there's a lot of agreement that the regulation shouldn't be the barrier to the right risk approach. I think that extends to all the discussions with sustainable finance, long-term finance. I think the industry is very clear that we're not looking for incentives, just the right risks. If it's measured in the right way, then we'll have the right business.
From a supervisory point of view, that is very important. Despite all discussions about green and brown and whatever, I think it should be risk-based, and we are prepared to acknowledge that. But it should be risk-based, and not because it's a political mainstream to invest more in these infrastructure projects. If it's risk-based, it's fine. If not, there won't be a supervisory discount on capital requirements. At least that is our very clear position.
I'm actually very glad to hear that, and it's an interesting comment. We're all clear, and we all agree that one of the key advantages and features of Solvency II as a framework is that it is risk-based as opposed to Solvency I. And I've also heard the debate in the industry that in some ways Solvency II may alter the level playing field because some companies will have a capital advantage as compared to others. And in my perspective, that sort of argumentation has to be looked at within the context of a risk-based approach. A risk-based approach, by nature, means that companies with either a lower risk exposure or better risk management practices will have lower capital requirements by definition of the framework. And that has to be reconciled with the concept of a level playing field, in our view.
I think we're going to, later on, we'll come a bit to actually some of the issues about convergence and which also come on that. I think that's definitely something we'll cover. But I think just to I think finish off on that, the sort of the big discussion around the long term. I think we have obviously sort of, as I mentioned in my presentation, I think there are some changes we think that can be made now as part of the 2018 review. There's obviously some wider changes that can be looked at under the 2020 review. But I think that any views on the issue of the risk margin, either now or later, is there an issue? And also on we've already covered, I think, the equity calibrations, and I think we think a more urgent action is needed. But I think you've indicated action should be at some point. But any views on those, the timing issue of when we make these changes?
You were missing one point in the 2018 discussion. That is the negative interest rate issue. I think you are missing that. I think that is, for me, the obvious discussion that we, in this time with these interest rates, a risk-based framework should cover negative interest rates, especially as we see it in the internal model companies. They are taking care of that. And I think it's just, for me, it's a kind of incredibility of a system which does not take care of this issue. So, and the risk margin is, from my understanding, a minor issue. 6% is, I think, not a very, very high capital cost of capital. And we went with IOPA very in detail through the calculations, and I think they showed up. But I don't know how you see it, but they showed up with a clear study that 6% is not exaggerated in my view. But you know, I can invite you to have these discussions with American colleagues about the right cost of capital in insurance. Is a philosophical question again, with the mochi and whatever. So I think let's stay it as it is. I think it's fine. But more important is negative interest rate.
You know, as maybe we are influenced by the discussion we are having with our US colleagues on the risk margin, but what is important that the risk margin remains in the system. Whether it is calibrated in the right way, I don't know. You know, we have to. There are other people that are looking at that. First of all, EIOPA. If you speak about the timing, you know, the timing is actually, it's an issue which is driven by regulators, not the supervisors. At the beginning, I have to confess, at the beginning of 2 years ago, I thought it was reasonable to do soon certain more selective changes to some aspects that to eliminate inconsistencies, to adjust the calibration, to simplify certain things, and then after a longer period of time to see how the long-term guarantees has worked. You know. Now I have to say that we have a clear view of how they work, and so we would not be against in doing everything together, you know, at this stage. But as I said, you know, this is an issue that is, you know, it has certain you know, other drivers. Yeah.
Well, I want to add two things. First is, again, there is that link with the long term. So risk management, risk margin tends to go up a lot with long term. From my, I think, statistical education, I always learned that the longer the time horizon, the less the volatility is and not the higher. So for me, there is a contradiction still between the two, and I think that need to be properly calibrated. The second one is, I think, more putting the risk margin in a broader perspective, as you did in your presentation, that you say, okay, I have my reserves, then I have my risk margin, then I have my SCR, then I have my target surplus on top of that. So let's not accumulate too much of the prudence and the margins on top of each other. The SCR, the liabilities are to be the best accurate measure for the liabilities that you have on the books, right? And the SCR is meant to absorb the shocks. That's how it has been done. And then you can put some target. But even on the target, now I see already a new tendency from the investors. But I'm surprised to see 2 years in the Solvency II regime that if a company misses its target solvency level with 1, 2, 3%, that you have quite a heavy reaction from the financial markets. We have seen a few cases where I say, look, if it really goes wrong and I'm a stress scenario and I go to 100% solvency margin, I'm fine. That's what the system is designed for, right? To absorb. So I see in the target, again, a new type of buffering coming in by saying, yeah, when you fall below your target, then already we see a heavy reaction. So that's my major request here is calibration. I think we can debate a lot. I have a lot of sympathy on the calculations Insurance Europe have done, and maybe we need a little bit more even academics to support and to quantify the two views. But let's avoid that we are accumulating too many margins on top of each other.
Yep. I completely agree with Hans. And just to add to that, on top of adding one buffer over another, I think that we've also significantly changed the interpretation of each buffer over the years. You know, at the beginning, I remember the times in which the SCR was a level of capital that you should eventually use in a very adverse scenario, and your absolute minimum was the MCR. And you know, today it looks as though the MCR has lost meaning in a way, and the SCR seems to be the absolute minimum that you need to cover under all scenarios and all circumstances. And so to us, that means that over the years, we've in fact created an additional buffer. The SCR is no longer there to be eventually used. It is meant to be always there as a capital buffer. And to me, you know, that adds on to the debate on the risk margin, which is again another capital buffer.
So yeah, I mean, I think that certainly the Insurance Europe view is that we can't wait for everything until 2020. Some things need to be done sooner rather than later.
But sorry, I would absolutely agree that we have to have an impact assessment on the whole bunch of measures. I absolutely agree with that, and that was part of our proposal for the negative interest rate, for example, that we have to look at it, how does it work when everything else is newly calibrated. I think that is very important because nobody knows what is the impact of individual measures, and that is I absolutely agree with that, and I think that we should do.
But I think that Ismael's point about the MCR, I think, is a very important one, because this point has been made a number of times, but again, recently we seem to have moved to an acceptance that the MCR has basically disappeared, and now everything's on the SCR. Is there any way we can go back to creating a system where the MCR actually has some meaning, and that the SCR is the target?
It has a lot of meaning. If you don't cover your MCR, you have a real major problem. You are not allowed to do a business anymore. So I think so it's very important.
Yeah. But is it fair to say, in your own views, that are you trying to avoid that the SCR becomes the new minimum, though, through various means? Because I remember there was a famous quote that many of us have requoted from Gabriel, saying that if you breach your SCR, you should have a cup of tea with your supervisor to discuss your plan to get back. But it seems we're very far from that.
Yeah, this is what I meant when I said approaching Solvency II with a Solvency I mindset. You know, it's clear that the MCR and SCR have two different meanings and trigger different types of reactions. But maybe, you know, when you move from economy to a legal, let's say, formalistic framework, you know, those type of tools could be interpreted in a different way. So it's not only an issue for the supervisor, but an issue for, you know, for the overall legal framework of the company, including the judges, you know, the tribunals. And
the market.
And the market.
Imagine a stock-listed company shows up with a solvency SCR ratio of 110 or something like that. As you said, they would really have a problem. I think what is the market expecting from a solid international stock-listed company? Is it 100, 110? I don't think so. I think if you talk to the CFOs, they know exactly what is the ambition of the market for their solvency ratio.
Yeah, but there is a link. We are now in the stress test exercise.
Yeah.
And there again, if you look at your results after stress, what should you look at? Should you look at your SCR at 100%, or should you look at your MCR to show that you're able to sustain the stress? I think that is a debate. I think that we should have, specifically with the request to disclose those results. Today the MCR is far in the background. to be used in the disclosure of these results. Yeah.
I agree with that. That was a conceptual discussion we had in the stress test. And I doubt whether it's prudent to publish the SCR figures after stress. Because that is difficult to calculate, it's difficult to judge, I think. But if you want to know whether a company is after the stress able to be still an active part in the market, I think it's conceptually right to do so. It's not just protecting the existing customers. Then it should not be beyond 100%. But so I think from a conceptual point of view, it seems to be reasonable for me. But I have my doubts whether it's reasonable to publish the figures.
Yeah, and I struggle personally to understand my competitors' solvency ratios when I read through the solvency and final condition reports, for instance. I think we'll have to do some more work in actually understanding those better, because we're mixing many things when we are publishing a solvency ratio. There's many companies who make use of transitionary measures,
Sure.
which obviously makes it very, very difficult to compare for others like ourselves who are fully loaded, so to speak, fully within Solvency II already. There's also companies who use Tier 1, Tier 2, Tier 3 capital, others like ourselves who use Tier 1 only. The solvency ratio doesn't capture that. It's simplistic, it's easy to interpret, but there's many elements which are not captured there, and that might be misinterpreted by the public. Therefore, the risk of publishing numbers, at least at this stage.
I absolutely agree that we shouldn't take the numbers and just comparing the numbers, but that is not the case only for the stress test. That's the case for the normal SFCR numbers, as you say so. And it was a big, I think, disappointment, at least in the German market, that they're coming in a lot of numbers now, and we are able to compare everything, and every customer can compare. I think that was a complete misunderstanding. We have a transparency for experts, and at least in German markets, if you look at the click rates on the SFCR reports, how many people are visiting the website for having a look to the SFCR report, that's very, very low number. And I think we should forget about that goal to compare it really. It's too complicated. It's an expert transparency.
I think that trying to boil an insurance company down to one number is always going to be unachievable, and I think we'll have to accept that our business is complex and requires some expertise. But I think the stress test we could have another panel on probably. So I'm going to move on to I wanted to mention though the convergence and harmonization. I mean, I think that when I hear the discussions about convergence and need to take action, I think sometimes we forget how far we've come. I mean, I think this journey we talked about, if we think about what it was like before Solvency II came into effect, how impossible then it was, absolutely impossible, even for an expert to compare across the different markets, for a company to manage that. My impression is that we've actually achieved a lot in terms of harmonization, and that the fact that it may take a bit longer to get to where we want to get to is somewhat normal. What do the panel feel about what we've achieved so far, and whether there's such an urgency to fix everything straight away that's remaining?
Well, first of all, because for an hour, I think almost we are a little bit complaining and fine-tuning the model. Let's go back to the principle. We came a very long way in the last 10 years. What you have seen on risk management, risk governance, modeling also of risks. I think I would say 80-90% of what has been achieved is just great. So let's be very honest. Even more, like I said in the beginning, in the pillar 2, the internal management in your risks, the ORSA report. I think most of the companies, also members of Aceralia here in Belgium, are very positive on what the ORSA reporting has achieved. What we, I think, should avoid is now tension between that pillar 1 and pillar 2 quantification by wanting to go more in standardization and comparing the results, which by consequence means moving away from the real risk profile that you are measuring in Pillar 2. I don't think we should increase that tension. Why? Because it's not only transparency also to our customers, and I agree with Frank that it is a very technical report to read, but let's not forget that the investors, and most of the clicks you see on the SFCR report is from the investors community, the investment banks. I've seen them coming up to me with tables and comparing now companies because they have been clicking on all those websites and they just put it in one table. And they make no comparison between all the underlyings, are there transitional measures or they're not. So our request would definitely be, let's not increase the tension there. Let's stay with the fact that it's principle based and that it should reflect as well as possible the real risk profile of the company.
I cannot agree more on that. On the other side, there are some aspects that have been highlighted as not, in line with appropriate harmonization. So I agree that compared to the past, the Solvency II really made a step forward in terms of harmonization or convergence, but at least managed to highlight the aspects that should be, some specific aspects that should be touched upon. And, maybe I'm not very saying something that is not very favorable here, but the issue, for example, of the treatment of deferred tax is an issue that where there was no harmonization, because it was principle-based, but maybe too much principle-based. And it was highlighted that the behavior of different jurisdiction was too different, with a big impact in terms on the SCR. So I think this is an issue, an example where more, without moving away from the principle-based approach, more guidance for convergence would be useful. But I agree that in general we should not exaggerate in this tension for convergence, also because there are certain aspects that do not relate to the regulation.
Yes.
They relate to the behavior of the supervisors. And this is the aspects on which maybe we as a supervisor within EIOPA should work more in the future, by highlighting the aspects where we behave in a different way. And so some of those aspects has very, very little to do with Solvency II. For example, the assessment of fitness and propriety of shareholders and managers. We know that we do not have the same metric in Europe. So
Let's
it's
agree
something
we do it at risk-based.
in a risk-based approach. So again, I think it's good not to exaggerate on that, but there are certain aspects that.
I absolutely agree on that, but I think that is now, it's simple, pure, hard work. And we have a working program in EIOPA. I think we made major progress, but now it's down-to-earth work, and we have a work plan, and we are working on several issues of convergence, and it will still take some years, because the cultural shift, for example, for German supervisors at the end of 15 to 16 was a major change. And it's obvious that not every supervisor has already digested 100%. That's very clear, and I think the industry is still the same. We are not 100% there, that we are fulfilling it legally, companies are fulfilling it legally, but it's a cultural aspect, and that takes some time.
Okay.
And just to say, up to now we have seen convergence as a way for creating a level playing field in the case of approval of internal models and so on. But now everybody knows that in the single markets, there is a quite huge cross-border activity. So consumer of one country could be affected if the supervision in another country is not appropriate. So this is the objective achieving convergence now from a supervisory point of view.
Okay, I think we've just a few more minutes to see if there's any questions from the audience. Any questions? No, no questions. Then what I would like to do just very quickly for each panelist, if you could just highlight one of the key benefit that Solvency II has brought and the key focus for one area of improvement. If you could, maybe starting with Frank.
It brought much better risk management, common understanding of risk management. I think we have still to work on the volatility and to be a little bit critical to ourselves as supervisors. We have to work a little bit more on proportionality.
I can agree. It's the internal risk management, risk modeling. I see the progress that has been made on modeling all the risks that you're having in your company, also disclosing them, talking about them, and leading the company based on the results, I think is just a dramatic change, and I think for the benefit of the companies, but also for the benefit of our customers, and having a good and sound market practice. So I think what we have been talking about here towards the review is what I really call a review. We should not turn around what we have achieved. I think we have built an amazing, impressive system, and now it's a matter of fine-tuning, and that's in 2080, 2020, and probably a few more times afterwards. But I see it as a positive thing. It is learning. We talk about academics. It's about learning and making progress to fine-tune what we have been building.
Yeah, I cannot agree more on that. Actually, this issue of introducing a risk metric in the regulation is a key achievement, and this will allows actually supervisors to have better tools, to detect problems as early as possible. The characteristic of to be a very good early warning system of Solvency II is the main achievement. On the other side, as I said, maybe the impact of short-term volatilities, which is the other side of the medal here, on the solvency ratio, represent the most important shortcoming to take care of. I agree. Also, supervisors should progress and learn more how to approach in a more proportionate way, the intensity of supervision. Not only the intensity of supervision. Maybe what we should improve of is to make clear what to the industry what should they expect in terms of intensity, based on the proportionality. I think this is the most difficult aspect.
First of all, I agree with everything that's been said before, and that will be additive in a way, just to add upon that. Data quality, I think, has been a significant advantage and a significant improvement for all companies as a result of Solvency II. It's been a great incentive for us to invest in data and to seek value from data. And as we face a digital world, I think that has many meanings in terms of competitive advantage today. In terms of outstanding issues, I mean, one overarching issue that I find personally in Solvency II as a framework is and you mentioned it briefly in your introduction, Olav, is the usage of the risk-free curve to value liabilities. When we look at local liabilities, I don't know to what extent, and I have some conceptual doubts as to whether a European-wide risk-free rate is applicable as a general framework in order to value local liabilities. If I were to buy a local portfolio of insurance liabilities in Spain or Italy, would I use the single European risk-free rate as a reference. You know, I think, and that underlies the framework of Solvency II, and that's the reason for us trying to seek adjustments and spreads, etc. But to me, you know, that's the underlying conceptual issue that we'll need to face.
Okay. Well, thank you very much, my panel, and I think we now move over to lunch, and we'll be back starting here at 2 p.m. sharp, please. Thank you very much.